Good morning and welcome to today's meeting of the Local Pension Committee, which is taking place at County Hall in Glenfield. This meeting will be broadcast live via the County Council website and will be available for viewing after the meeting. Can everyone please switch their microphones on when speaking and remember to turn them off when you have finished. I've received apologies today from Mr. Bill, Mr. Grimley, Councillor Clark and Mrs. Page. I welcome Mr. Harrison, who is substituting for Mr. Grimley. Please note that there will be a training session after the meeting, which will be an overview of the LGPS Central's responsible investment and engagement approach. Before we start the meeting, I'd like to take this opportunity to thank those local pension committee members who are no longer on the committee this year, namely Councillor Nigel Grundy, Councillor Sue Waddington, Jeff Lawrence, and I would particularly like to thank Councillor Melise Graham, who spent many years on the local pension committee, as one of our longest standing members. Thank you all for your time on the committee, much appreciated. So the first item on the agenda this morning is the minutes of the meeting held on the 16th of June 2023. I propose that the minutes of the meeting held on the 16th of June 2023 are taken as read, confirmed and signed. Is everyone in agreement? Yep, that's agreed. So we move on to item 2, question time. I have received no questions. Agenda item number 3, questions are asked by members under Standing Orders 7.3 and 7.5. We have no questions. To advise any items which the Chair decided to take as urgent elsewhere on the agenda, I've not been notified of any urgent items. Have we got any declarations of interest in respect of any items on the agenda this morning? No, I'll take that as no, that's fine. So the first item is the DTZ International UK property update, which we are going to defer. I move that we defer this till later on in the meeting because the gentlemen who are coming to present a presentation for us are somewhat delayed. So is everybody happy to do that? Delay this till later on? Thank you. So we now move on to agenda item 7, the annual local pension board annual report. I've received apologies from Mrs. Page, chair of the local pension board, as she is unable to join us today. She has, however, prepared a statement regarding the annual report, which I've agreed to read out following the officer presentation. So, Ulas, could you take us through the report?
Thank you, Chair. It's really short. The purpose is to present the committee the annual report of the Local Pension Board for 22-23. As part of the Fund's independent governance review undertaken in 2020, a recommendation was for the board to write an annual report as best practice. The report provides a summary of the work carried out by the board covering the period from April 22 to March 23. The report was approved by the local pension board on its meeting at the 2nd of August 23 and will go to the pension fund annual general meeting on the 11th of December 2023 held at County Hall.
Okay, so it's a very straightforward report. Has anyone got any comments or queries on it? Can't think that there would be. No? Okay, so I will just conclude. I'll just read out the report from Mrs. Page. So Rosita has said, I'm pleased to present the Local Pension Board's annual report for this year. The report outlines the work we have done to assist the administrating authority to ensure compliance with the regulation and efficient governance of the fund. Throughout the year, we have scrutinised the fund and have no concerns to raise on the fund or its administration. Some key areas we have focused on include the new national dashboard project, which will enable UK residents to view their pension information in one place. We're assured that it was expected to increase awareness and reduce the number of calls to the pension helpline. We have also regularly reviewed the risk register at each board meeting and continue to monitor employer risk, including outstanding bond and admission agreements. In addition, we have scrutinised the fund's business plan and budget prior to consideration and approval by the local pension committee. We have questioned the significant pressures on the pension section resulting on upcoming pieces of work on top of business as usual. The most significant being the implementation of the pensions dashboard, the cloud, the pension regulator's new code of practice, and reviewing the fund's additional voluntary contribution provider. We were assured the pension manager will monitor this closely. As a board, we will continue to receive regular training to fully undertake our role. I would like to conclude by expressing my thanks to my fellow board members and officers for their contribution to our meeting. So we're just asked to note the report. So is everybody happy to note the report? Yeah. So on to agenda item 8 is the Pension Fund Annual Report and Accounts, pages 47 to 144 of the agenda pack. Again, this is a fairly comprehensive report. The annual accounts are subject to audit and will go through to the Constitution Committee eventually and come to us as well. Does anyone have any comments or questions they'd like to raise on the accounts? Yeah, Zubair.
Thanks, Chair. Just probably for completeness and accuracy, the recommendation section on the paper, the Pensions Committee is asked to approve the annual report accounts of the pension fund for the financial year. Should we also be having an extra sentence saying subject to the audit being finalized? It doesn't mention it in the recommendation. Yes.
Let me start again. I'm certainly not having a good morning. We are to approve the annual report and accounts of the pension fund for the financial year 22-23, subject to audit, and that's agreed. And we're also asked to note that the Corporate Governance Committee will receive the external audit of the 22-23 Leicestershire County Council Statement of Accounts, Annual Government Statement and Pension Funds. Is that agreed? Yep. Okay. So the next item we come across is item number 9, which is a pooling consultation, next step on investment and the LGPS central meetings update on pages 145 to 148 of the agenda. Bhulesh, if I could ask you to present this.
Thank you, Chair. So the purpose of the report is to inform the committee of the consultation paper issued by DLUC, the Department for Levelling Up Housing and Communities, on the 11th of July. It's titled Next Steps on Investment, to seek the committee's views on the proposed responses to that consultation and to seek approval for the Director of Corporate Resources to be authorised to finalise and submit the consultation response on behalf of the fund by the required deadline of the 2nd of October 23. There's a smaller section towards the back of this paper, which also provides the committee with an update regarding LGPS Central's Joint Committee, Annual General Meeting and other relevant matters. A bit of background is covered off in points 3 and 4. As set out in the investment strategy statement, it is the fund's intention to invest its assets through Central as and when suitable pool investment solutions become available. Central has been in operation since the 1st of April 2018. As at the 31st of July 2023, the fund has circa 2.2 billion invested in Central, as well as over £350 million in uncalled commitments, which will increase its overall pooled exposure. Outside of Central, the fund has 0.9 billion invested in low-cost passive equity funds with Legal and General. The fund would consider these Legal and General investments to be pooled given the investment management savings originally achieved from the joint procurement with other LGPS funds. Just a bit of additional information there would be, including the Legal and General funds, we have 2.2 billion already pooled. That's more than half of the fund, and we still have significant uncalled commitments, which would further increase that percentage. Pooling was first initiated in 2015 by the government. 2018, Central's formed, and in July 2023, the government launched the long-awaited consultation. The consultation proposes to accelerate and expand LGPS pooling, setting a March 2025 deadline for funds to transition all listed assets, and target for funds to invest up to 5% to support levelling up in the UK, and to set an ambition for funds to have 10% of their assets invested in private equity. The deadline for responses is the 2nd of October. The fund's proposed responses is covered below, and the first of the three areas just mentioned start at point 12. That's asset pooling. The government made it clear that it wishes to see pooling move further and faster to substantially increase scale and drive better value for money. It is the government's view that benefits of scale are present in the 50 to 75 billion range and improve up to 100 billion, which could eventually lead to further proposals by the government to subsume or merge pools. Partner funds within Central have assets under management of 55 billion. As at the 31st of March 23, 49% of those assets have been transitioned to the pool, whereas another 32% are externally managed passively. So that's the LGIM funds we mentioned earlier. It's proposed that in the response to the consultation, the fund objects to any proposal to subsume Central into another pool or vice versa. This is largely due to cost, complexity, timing and issues around accountability and governance. Instead, there are plenty of opportunities remaining for collaboration with partner funds, investment advisors and pools to support the primary aims of funds and pooling objectives. Government proposes to set a deadline requiring administering authorities to transition all assets to their LGPS pools by March 2025. As presented to the committee in the June 2023, Leicestershire is the second most pooled fund within Central. As at the 31st of July, the fund has over 2.2 in pooled products with Central. The government will need to be clear on whether such low-cost external passive holdings can be classed as pooled. Furthermore, it is considered that a deadline to pool is not achievable while the fund considers its strategic asset allocation annually. Often, asset allocations are most fundamentally reviewed following actuarial valuations, the next such valuation for the fund being March 2025. It's proposed that the fund's response identify opportunities where funds and pools can instead interact further. This includes making the most of any areas where funds can align their approaches, such as involving pools in the development phase of the strategic asset allocation process, while retaining ultimately any approval of the SAA, the strategic asset allocation at local level, as well as consider whether it would be appropriate to procure one joint investment advisor firm per pool, which could support cost reduction and possible alignment of investment approaches. Before I move to the second main point, are there any questions there?
So, questions from anybody? It's Nick.
Thank you, Bhulesh. In terms of the passive funds that we've got, is the government's proposal actually to try and suggest that we pay transaction fees to transfer it to a higher cost regime for the same assets? In which case, should we not just classify them as pooled and not wait for the government to tell us that they're pooled and just say that's our opinion and let them challenge us?
Yeah, I think the actual words are transitional listed assets. Now they don't make a case one way or the other whether or not something is really cheap and would cost you additional fees, management fees and transaction fees to move across. We've always been of the opinion that Leicestershire and seven shires, as the agreement is known, was procured a number of years ago, and it's a very low cost arrangement, and in order to move that would cost the fund substantial amounts of money in transaction fees, like you say, but also exposes the fund to some risks as part of that transition. So I think you're right. We are suggesting and will state as part of the response that we would object to that.
So just to add to that, in fairness to sort of Central as well, they're aligned on this, that it is a slightly farcical situation you describe, and there must be a way around it where we just put like a central wrapper on top of the passives, and Central are bought into that as well, that we don't just got to be shifting things around just for the sake of ticking a box. So we should be able to find a way through it.
Yeah, I think we'd all agree with that. I mean, I think Bulesh's presentation has sort of encapsulated everything. It is proposed that the fund disagrees with any proposed that prescribes allocation decisions. Ultimately, it is for the fund to agree their risk appetite with advice from the respective investment managers and actuaries, which makes absolute sense. We have a fiduciary issue to responsibility. I think the government recognises that. Has anybody else got any other questions or queries? Yep. Mr. King.
Thanks very much, Chair. Just trying to get my head around this a little bit. So pooling is meant to drive lower transaction costs and efficiencies, in inverted commas, of actually holding the funds, because there's investments, there's charges for transactions, buying and selling, and there's charges for sort of managing, in inverted commas, whatever that means. If we have bigger amounts of money invested through pooling, shared risk, then essentially, because we're pooling it, although it's still our money, but it's in this wrapper of a pool, the government's saying, let's make these pools even bigger. Am I right in that? That's the understanding? And make them even super bigger than what they already are, because we think there's more efficiencies. But what it isn't spelled out in this report is, what are those efficiencies from 0.5% charge against the funds to 0.49%, or is it, and obviously on a big amount of money, that's a big number, but is it, what are we talking about? Because I feel I can't really offer a thought about it, because I don't know what the quantum is, what the quantitative proposal is. It's quite difficult. This is kind of, well, it sounds like a good idea, but is it? I don't know. And that's kind of hard. Given that we're talking about money and investments, it would be quite handy. So I'm not looking to sort of stop anything, but I just think, if we are having reports like this, an example will be really, really helpful, Chair, in future reports, to sort of explain what we mean by what the, or if the government proposal, because I'm presuming there is some technical data the government's put out, or maybe they haven't. I'm getting a shake of the head there. So they haven't done that. That's even more helpful, isn't it?
Yeah, I think it's very difficult. I mean, this is a consultation.
It's really hard to comment, because I don't know what.
Yeah, it is a consultation, and I'll come back.
Benefits of scale. Well, yeah. What benefits?
Well, it's very. I think you make some good points, but it will come back after the consultation. I think officers will sort of iron it out. But to be quite honest with you, with 7 local authorities in the pool funds, they all have different demands and objectives, and if we mass it up more, it's like having a committee with 100 people on it rather than 10.
Well, I can also see that being more problematic with governance and oversight, because if each member of the pool only has.
I'll sort of refer it to officers, but my view is, if we go to consultation, we put our views in, and I think your point about the charges, well, it's an unfallible one at the moment, because we just don't know. But Declan, if you could add something, it would help.
No, I'm just sort of, I was shaking my head that the government haven't troubled themselves with any sort of data or evidence behind this. It's more, you've got to buy into it philosophically, I think. And that's kind of, I suppose, our worry on this one, that we've set out a direction, and fundamentally we have seen it as we've pulled. Managers have been forced to drop their fees, which is basically they're just dropping profit away, because once you've set up your structure, the more assets you add and add, it tends to be fairly small what the additional costs to the managers are. But I suppose our concern is once we've set up on this sort of track, and we've got sort of company structure set up, etc., that disruption to then go into another structure where the increase in scale is sort of more marginal, it's not as certain as maybe it was before. So I think it was easy for the government to do it on the initial sort of set of pulling and say, get more scale and it'd be good. Now it's harder to see, so I think it is more a philosophical one rather than an evidence-based one, which isn't great.
Mr. King, yeah.
I mean, ultimately, obviously this isn't a matter we can philosophically, I get it, but if it's meant to be a local government pension scheme, and if it's meant to be decisions about investment and what we do with the money are meant to be made, obviously within the strictures that are placed on us by national regulations, but if those decisions are meant to be made locally, then if you create a huge super pool, effectively, where do you stop? Effectively, you end up with a pool of everything, which effectively becomes a nationalised local government pension scheme. If that's the direction of travel, so I assume the Treasury is driving this because they think there's some cost savings. But what those cost savings are, as you say, Declan, none of us really know because it's not spelled out. Thank you, Chair.
Just quickly on that, on where they're going, because you're right. Sort of it does to take certain elements away from sort of the local side, and where they seem to be still roughly keeping the dividing line is that the committees will set the sort of strategy, but the pools will then design the products and actually sort of implement them. So they're saying the sort of, I suppose, the local control is those decisions about whether you invest in equities or bonds, that sort of higher level strategic, as opposed to picking manager A, B, C, or D. So that tends to be the dividing line they're going for.
Okay. Right.
Thank you, Chair. Yeah, we've got to be careful about mission creep here from the government. I mean, I think the initial target is 7.5%. Was it 10 in terms of the scope of how much we've got to invest in these areas? But if it goes beyond that, I think we need to be clear.
Yeah, private equities, they're targeting 10%.
10%,
funds.
Yeah. So it could be 10, 15, 20. That's what we've got to be wary of, I think.
Yeah, I mean, the report itself sort of outlines at the moment we've got 21% invested in the UK, and if we have the undrawn commitments, it goes up to 25%. So we're all many ways we're already there. But I think without prolonging it, I think we know what our duties are as a pension committee, and interference from third parties with directions is possibly not very helpful. And I'm sure this has got a long way to run before it actually comes into fruition. I think there was consultation, and the points that officers have made within the report are absolutely valid. And I think we would confirm those thoughts and add our agreement to them. Has anyone else got anything else?
I was just going to say, Chair, we'll incorporate the kind of, I suppose, the tone that the sort of different members have sort of raised in terms of when we do sort of draft the sort of that final consultation response around the kind of concerns of the lack of evidence, the kind of potential for box ticking as opposed to substance in that sort of mission group. So we will make sure that's sort of blended into the consultation.
Thank you, Jeff.
Yeah, I'd just like to sort of agree effectively with people on that, particularly about the private equity bit. And even the levelling up, it's not for the government to decide how we invest. There are assets, they're not theirs. And it's a very big, difficult, precedent for the governments to sort of use LGPS assets for government policy. It's because the LGPS actually nationally has been a success. If you look at the whole of the pensions throughout the country, you've got the government pensions that are unfunded, which causes a problem in the future, and you've got private sector DB schemes that are all closing and have lost an awful lot of money because of leveraged investments, and you've got private sector DC schemes which are at least something, but they're inadequate. So you've got the local government scheme, which is the success, and now they're having a go at that. Don't agree. I think we really need to be robust on the response.
To be honest, Nick, I don't think anybody's going to disagree with that. But certainly, there's some very valid points being made. And I think, that, as I said, the officers within the report have highlighted very clearly what the issues are. And I think, as Declan has said, he is going to put that in the response to the consultation. It will come back. And again, Bill, you've made some points about what are the savings. The reality is nobody knows. Nobody actually knows. So this is a consultation. It'll come back. Has anyone else got anything else they want to say about this? Yeah.
Just want to pick up this point about the levelling up 5%, up to 5% of assets and levelling up. Now, actually, I do actually support this. Whether that's the right mechanism or whatever they're proposing, I'm not sure, but it is something I actually think is actually something that would be a useful thing for pension funds across the board to do. So I just want to make that. I have said that previously. So so just to be clear, the consultation is going to come back then at a later point.
Well, the points that we raised, well, I mean, as I said, we've got 21% of our assets invested in the UK already. I think the best thing to do is to wait the results of the consultation from all local authorities. And correct me if I'm wrong, Declan, but it will come back, won't it? The results of the consultation.
So the path from here is the reason we haven't brought a fully final one is because Bhulesh is still working with sort of other colleagues at LGPS Central and the other sort of the funds to see if we can align as much as possible to try and sort of strengthen that voice. So everybody's at a different stage, hence we're more trying to, I suppose, get the principles, and then we'll produce the sort of the final draft that will get submitted. But the intention was to take that final draft back to here because the November committee won't work with timing. But then obviously when the government responds, we will bring what government are going to set out back to us here, and then how do we respond and actually sort of enact that.
So some all valid points. I say the report really does clarify everything that's and amplifies what's been said this morning. So if there are no further comments or questions, right, Bhulesh, you've got some more to report. I'm assuming everyone is ready.
We've jumped ahead a little bit, so I won't go over the parts we've already talked about. So we've already started talking about levelling up and the levelling up white paper and its ambitions to set a 5% limit for levelling up. So we've talked about that. If you just scroll over to point 27, you can see a little table there that shows that 5% target versus what we've calculated for our fund currently, which shows at the bottom of that table of the 5.7 billion assets under management, we think around 21% is already invested in the UK across a whole swathe of asset classes. As you can see there, the column on the far right of that table shows the undrawn commitments. If you add them on as well, you're up to about 25. But the point being that we're well over this kind of threshold that the government are looking at for UK investment. The third part to this was their requirement or target or ambition for 10% in private equity. And again, we've got a point at 35, which shows that the fund only targets a 7.5% as part of its strategic asset allocation. And the majority of that is split between LGPS Central and Adam Street Partners. And of that 425 million, 7% is, we think, is invested in the UK. And that compares quite favourably to the UK share of the global market, which is around 4%. So we already have more in the UK than we would if we were to take a wholly balanced global view. That kind of takes us to the end of that consultation piece. I think we've covered a lot of the questions for all three areas already, so unless there's any further ones.
Chair.
So just make sure I understand it. So currently the target is 10% and we're at 7.5 at the moment.
So the government's consultation proposal is a 10% target to private equity. Our fund has a 7.5% target. So our investment advisor has said 7.5% is the right target for you to generate the right returns.
So, Zubir.
Yeah, thanks, Chair. Just on paragraph 22, there's 12 sort of missions which have been set out. Do we know from the 21% that we've got invested in UK whether we've got coverage across those areas? Because that will make it a lot more, hopefully, stronger in terms of saying we already have exposure in these areas. That makes sense?
But we thought about being able to classify that, but it would take an awfully long amount of time to ask our managers to say what of all our investments, which ones are ticked. But when you read those, you can pretty much say that any investment we have will probably very closely tick, at least one of those. It's very hard. They're very wide and far-reaching. Things like research and development, transport, digital connectivity, education, skills, health, well-being. They're very, very wide. But no, we haven't done that bit of work. No.
Okay, so thanks. So, Bulash, have you want to say something else on this report?
I was going to say that the second part of this paper is the LGPS Central update, which we always bring through here. But in the interest of time, I'd rather say, is there any questions for that section at this point?
Okay, so we've had quite a debate on this. Has anybody got any other further points they'd like to make? I'm sure other local authorities will be making the same points in their meetings as well. So I think we can entrust the officers to put forward our thoughts on it. Everybody happy with that? No further questions. So the committee has been asked to note the government consultation titled Next Steps on the Investment and the proposed responses to be made on behalf of the fund, and all the comments made will be encapsulated in our response. Is that agreed? Yeah. So everybody, authorise the Director of Corporate Resources, following consultation with the Chair of the committee, this committee, to prepare the detailed response to the consultation on behalf of the fund, taking in account of any comments made by the committee, and submit this to the government by the deadline of the 2nd of October 2023. Is everybody happy to do that? Everybody agreed? That's fine. And finally, note the update now provided regarding LGPS Central was Joint Committee, Annual General Meeting and other relevant matters as outlined in the report. Is this agreed? Yep. Thank you. So, okay, we'll take if they're there, if we could get them in, and we'll take their report next. So we're going to, the gentlemen from DTZ are here, so we will take their report now. Yeah, yeah. Okay, so welcome to Sam Bryce and Andrea White. We're now going to consider item number 6, which is the DTZ International UK property update. And I'm going to ask Bulash to introduce the report, and then we will hand over to Sam and Andrea for their presentation. So, Bhulesh, over to you.
Thank you, Chair. The purpose is to provide the committee with information on the fund's direct property investments and the performance of the UK Direct Property Fund and market outlook. There will be a presentation from DTZ delivered via PowerPoint. The fund has direct property allocation currently managed by Colliers International, which is valued at 118 million as at the 30th of June. It's mainly directly owned property with a couple of pooled funds. The fund also has property investments within an open and closed-ended products with two other managers, which at the 30th of June totals 303 million. Taken together, total property holdings of 421 million or 7.3% of total fund assets are short of the target allocation of 10%, which was agreed at the local pension committee meeting held on the 20th of January 2023. As part of the decisions taken by the investment subcommittee on the 27th of April 2022 meeting, it was decided to move management of the Colliers direct property investments to DTZ at the appropriate time. It was also agreed that when LGPS Central finalised the mandate with DTZ to launch a UK direct property fund, the fund would invest an additional 120 million over 2 financial years in order to close that gap to the target property allocation. So that's the gap, which is the 7.3% we currently have to the 10% target. The fund has committed 60 million to that new fund with DTZ, and 60 million remains to be committed as part of the changes agreed at the 27th of April 2022. Officers have been working with LaSalle also to reshape the UK and global mandate. It was noted that this change could take a number of years and will need to be carefully managed, and once the portfolio had been reshaped, the Director of Corporate Resources, in consultation with the Chair of the ISC, be authorised to agree a new benchmark and target objectives. At point 9 in that paper, the DTZ mandate objectives are listed. I'm sure Sam and Andrea will run through these, but they're listed there for your reference, points A to H. At present, no purchases have been made by DTZ from monies already committed, so that's the 60 million I was talking about earlier, and the market currently presents opportunities and new buyers, such as the fund can pick the right areas of the market which are likely to outperform. The presentation from DTZ covers this in more detail. That's all.
Thank you, Bhulesh. So committee, the slides that are going to be on the main screen are also at the base of the agenda item, so you've got them on your laptops as well as on there. So thanks for coming this morning. Over to you for your presentation.
Thank you very much, and good morning, everybody. So yeah, we have a presentation today which covers a range of items. First of all, we're going to provide you with a market update, which will look at the economy, the investment market, and also our outlook for the occupier markets within the real estate industry. And then we'll go on to provide a summary of the sub-fund, its targets and its objectives. Okay. Yeah, so we go to the next slide. Thank you. So we thought we've got a number of slides which deal with those aspects I've mentioned in a bit more detail, but we thought we'd start with a summary of where we see the market at the moment. So what have we seen recently? Well, there's been a marked change in sentiment in the commercial real estate market towards the middle of last year. And that was driven by various macro economic factors, inflation, increase in interest rates, increase in bond rates. And that culminated in a repricing of the market in Q4 of last year. And then whilst when we came back from Christmas in Q1 of this year, there was improved positivity, particularly in the retail, warehouse and industrial sectors. As we move through the year, the stubbornly high inflation, the higher than expected prolonged period of interest rate rises have extended that kind of period of uncertainty. And what we've seen so far this year is some marginal falls in capital values, which we were forecasting, and we have seen a good proportion of that already through the first half of this year. As a result, transaction volumes are down. That is a result of a limited number of buyers in the market, partly as a result of the change in debt pricing. So debt-backed buyers find it now more difficult to buy because the debt is no longer accretive to investment returns. It's also as a result of more limited sellers in the market, and that's partly sellers holding off sales decisions, waiting for greater certainty around pricing. So on the occupational side, though, we have seen some resilience, particularly in the industrial market, where there's a lack of supply, which has supported further rental growth, and there remains robust tenant demand for industrial space. And you could also say the same for the retail warehouse market, where vacancy rates are falling. So overall, we'd summarise by saying that we remain cautious on pricing, but we do see opportunities, particularly amongst those sectors that are more resilient, and those sectors are the ones with a positive outlook for the occupier market. We really see those as being the industrial sector and the convenience-led retail warehousing sector, and also supermarkets, and the latter two really being supported by or less affected by the impact on squeeze on discretionary spend. We move on to the next slide. Andrew will pick up the various the slides on the economy and investment market.
Yep, so starting off with market performance. So commercial property performance was mildly positive in Q2, but there were signs of weakness towards the end of the quarter following the 50 bips base rate hike in June. This caused the all property equivalent yield to soften, and it also caused capital values to decline in Q2. So as a result, what we saw was capital property total returns were only 0.5% for the first half of this year. But performance on a sector level was highly polarised. So we saw total returns ranging between sub 5% to minus 7% over the period. And it was those sectors that were underpinned with strong market fundamentals, so that was the industrial sectors and also residential, as well as sectors with a very high yields, which were predominantly the retail sectors, that performed the best over the first half of 2023. In contrast, the office segments recorded negative total returns, and that was all the office segments in the first half of the year. And this was because the positive gains that we actually saw from income returns were completely wiped out by capital value declines. Onto the investment market. The investment market activity has been subdued, as Sam was mentioning, and that was largely due to the higher cost of debt and also reduced investor sentiment, which weighed on investor volumes. So volumes overall for the second quarter of this year totaled 7.4 billion, which was 11% down on the previous quarter and around 40% down over the 5-year quarterly average. The office sector was the main drag on Q2's volumes, and this was largely due to concerns around structural changes in occupational demand, as well as ESG remediation costs. However, not all sectors saw a fall in investor volumes. In actual fact, there were some sectors which were well sought after by investors, and that's namely the retail warehouse sector, the industrial segments, and some alternative segments which actually saw volumes improve between Q1 and Q2. In terms of the economic outlook going forward and the impact it will have on the property market, I do expect that the current economic conditions will weigh on commercial property performance this year. So the high inflation, high interest rate environment will weigh on consumption and business investment. That will lead to more softer economic activity and a softening in occupational activity as well. In addition, the high level of core inflation will keep the base rates and also gilt yields elevated, and that will put pressure on all property equivalent yields as well as capital values for this year. As a result, we actually expect the all property equivalent yield to move out by 40 bips this year, and that will lead to a 4% reduction in capital values on an all property level. But as inflation eases and interest rates and gilt yields moderate from 2024 onwards, property yields should modestly compress, which together with some positive rental growth will push capital returns back into positive territory. And we'll come on to our forecast later so you can see that in a bit more detail. But if we move on to the next slide, which covers the retail market and what's happening there. So on the demand side, we've seen a slight improvement in retail footfall in 2023. We've seen also a modest uptick in the number of proposed retail openings. And this is largely because we've seen a rebasing in retail rental values, which has made retail space a little bit more affordable for occupiers. But on the consumer side, confidence has softened, and that's due to the persistent inflation, also higher interest rates. And this is likely to weigh on retail sales in the short term. Now, according to PMA, the outlook for retail sales growth is expected to be muted, with spend predominantly going to be focused on essential goods only. On the supply side, we've seen vacancy rates fall across the board. And we've also seen limited new development in recent years, with the exception of the food store sector. So we've seen a few new food supermarkets being open. Despite this, there still remains quite a lot of excess supply in the retail sector. And according to PMA, approximately 29 million square foot of town centre retail space, which equates to 4% of total retail stock, will either be repurposed or it's going to be removed from the market over the next couple of years. But what this will mean is that, at least in the short term, the excess levels of supply that is going to be in the market is going to weigh on retail rental values. However, despite that, the sector will still continue to deliver an above average income return for investors, and that will be enough to hopefully provide performance that will be above the all property average. Across the retail segments, we think the best performing retail segments over the next few years will be those essential-led segments such as retail parks and also supermarkets. Move on to the next slide, which focuses on the office sector. In terms of the office market, take-up has slowed across both London and also the regional office markets in Q2. Demand has also become increasingly polarised, so we've seen occupiers seeking high-quality space with strong ESG credentials. In terms of office supply, availability has increased both in London and the regions, and it's second-hand space which accounts for the bulk of supply across both areas of the market. Now, vacancy rates do vary across the locations across the UK, and within the regions, they range between a low of 5.5% for Edinburgh to a high of 10.5% for Glasgow, while in London, they range between 7% for the West End to a high of 17% in the Docklands. Looking forward, we expect the office sector will underperform the all property average over the next 5 years as a result of hybrid working practices and also tighter ESG credentials, and which will negatively impact both occupancy and also investment demand for office space. The better performing sectors of the market will be the higher quality end of the market and those assets with strong ESG credentials. Moving on to the industrial market. Demand in this area of the market is also cooled, but this is after 3 strong years of very strong leasing activity. So logistics take-up was down 16% over the quarter, and standard industrial take-up was down 18% in Q2. Void rates have also increased by about 70 bips in the first half of this year, but despite this, they still remain below the 10-year average of around 6.5%. Looking forward, we expect 2 structural drivers will support both demand and also rental growth, and that will be the growth in e-commerce and also onshoring of occupiers' inventory stock to improve their supply chain resilience. Over the next 5 years, we expect all of the industrial segments, both standard industrials and logistics, will outperform the all property average. If we then move on to the ESG update and the impact it's having on the commercial property market. Overall, we see 2 sectors where we are starting to see the effects of ESG impact both occupier activity and also performance, and that's the office market and also the logistics market. So on the occupational side, we're seeing tenants becoming more selective and opting for more efficient prime stock over lower quality space. And this is in order to help them lower operational costs, but also to help them meet their corporate social responsible commitments. Now, this is visible in the take-up figures. So if you look at the logistics market, around 50% of the stock that was taken up between 2010 and 2014 was prime space. Last year, 80% of the stock of prime stock was actually taken up. Now, this shift towards better quality stock is increasing the performance differential between poorer stock and higher quality stock. So according to the MSCI numbers, the rental value differential between high yielding and low yielding industrial stock has increased from 12% to 25% respectively. We're seeing the same trends occur in the office sector as well. So capital values on low yielding, very prime office stock in London fell by around 5% between 2020 and 2023. Whereas poorer quality office stock in the London market actually declined by 25% over the same period. So we expect this trend will continue going forward as legislative restrictions tighten and more occupiers look to modernise their distribution networks in order to offset the carbon footprint of their businesses. So if we move on to the next slide, which focuses a little bit more on our all property forecast for the next 5 years, so you can see this in a bit more detail. What you can see here is, especially in the first year, 2023, we're expecting a low all property total return. You can see that by the red marker, which is the actual total return. So it's around 0% for 2023. And this is because capital value falls, which you can see in grey, are being offset by income, offsetting the income return. However, from 2024 onwards, we actually see some capital value recovery in the all property market. And so this, combined with around a 4% income return over the period, will lead to stronger returns of around 7% plus for 24 to 2027. So for the full 5-year period, we actually expect the commercial property would deliver a 6.1% per annum total return over that 5-year period. Now, on a segment level, total returns are expected to polarize and vary significantly over the period. So we actually have our 5-year segment total returns varying from a high of plus 9% to a low of 1%. Those segments that we think will perform best over the period are those which will be underpinned by ongoing rental growth, healthy income returns, and also positive long-term structural trends. So we've got those segments listed on the right-hand side of the slide, which are multi-let industrials and logistics. They're also retail warehousing, particularly those which are focused on convenience retail. They're also supermarkets, they're going to perform well. And also some of the high-yielding retail segments, such as retail units, but largely in those major towns. Now, in contrast, it's going to be the office segments that are expected to deliver the weakest performance over that 5-year period. And that's due to a number of pressures that we mentioned earlier. So the structural changes to occupational demand because of hybrid working, but also because of the increased capital expenditure costs that will have to be paid out due to make the office assets more ESG friendly. So both of those factors will reduce future returns over the next couple of years, and returns across the various segments of the office market will range between around 1% to 3% over the period. I think that's it for the market.
Just move on to the next slide. So the next, I think we're going to another 3 slides here. They focus. Sorry. Sorry, we've got another 3 slides here, and they focus on the sub-fund, the requirements and the strategy, and really what we're trying to achieve with the sub-fund. So in terms of the overall requirements for the sub-fund, we've split them into three columns in this table here. So first of all is the allocation. The overall aim of the fund is to invest £500 million over the medium term. But in the short term, to invest around £150 million over the next 12 months. Now, as Andrea said, there are certain sectors that are more resilient and those that are expected to perform better. And those are the sectors we'll be targeting in the short term to invest into. So those markets with a robust occupier demand and also a more positive, stable outlook for investment pricing. In the second column, we've had the investment performance requirements for the fund, and those have been set at a margin above the benchmark. The benchmark is the MSCI quarterly returns index, and the target is to outperform that benchmark by 50 basis points on a 3-year rolling basis. Now, we think that in order to achieve this, we can take limited risk in terms of the scale of risk in the real estate market, where we focus more on the core and income focused side of the returns, in contrast to development value add, which is more risky. We think in the short term, based on the sector picks that we've set out, so the industrial, retail, warehousing, supermarkets, we think that that will outperform the market by the nature of the returns that we're forecasting versus the overall market forecast returns. And we'll be focusing that capital in core markets, in prime, sustainable markets where there's dynamic demand from a range of different occupiers to help support the income and therefore the values of those assets. And then in the third column, we have ESG targets. Now, at Decent Investors, we've set a net zero target of 2040 with interim targets 2030 leading up to that in order to decarbonise our portfolio. And we will also apply that same approach to the sub-fund. And with the sub-fund, we have the opportunity to build the sub-fund from the ground up, focusing on those ESG targets. And we'll do that through identifying asset quality through acquisition, identifying opportunities to decarbonise, to improve the quality of the assets, and help us to get to that net zero target in 2030. sorry, 2040 and 2030. So to really summarise the strategy for the sub fund, as we mentioned on the previous slide, the target performance target is a 50 basis points outperformance of the benchmark. And as I mentioned, we think we'll do that by allocating the capital across a lower risk style of assets. So that would be around 75% of the assets invested into what we call core income assets, i.e. the assets returns are driven by the income that's delivered from that asset rather than capital appreciation necessarily. Market growth, where the returns are driven by capturing rental growth within those dynamic markets we'll be investing into. And also assets where there is a bit more leasing risk, but in those core markets with strong underlying demand, but would achieve the returns through active management of those assets, securing the rental uplifts, re-gearing leases and adding value that way. So it's very much a low risk approach to investing. As also mentioned, we'd invest into sustainable markets, sustainable locations where there are a number of occupiers that want to occupy those buildings, or also there's a number of different uses that those buildings can be put to. So there's just core underlying demand for those assets that helps sustain value. And we expect to invest around 50% of the portfolio in London and the South East, with a remainder in major regional centres, Big Six markets. Now we want to build a robust, resilient portfolio, and a key part of that is building diversification into the portfolio. So we mitigate various risks, both credit risk and lease expiry risk, by building a diverse portfolio with a large number of tenants, but concentrating into those relatively small number of highly sustainable locations. We do generally, across all of our funds, take a fairly active approach to asset management and drive added value through agreeing new leases with tenants, capturing increased rental through capturing rental growth. And that's the approach we'll take with a sub fund. But again, taking a low risk approach, we'd like to build a portfolio with an unexpired lease time across the portfolio of around 6 to 10 years, which is in line with the benchmark, and also ensure that the void rate within the benchmark at any one time, within the portfolio, isn't any higher than the benchmark itself. And finally, as I mentioned, investing into these markets where there's alternative occupiers that might want to be in the buildings for alternative uses. We'll invest into those assets that are capable of being transitioned to meet those other alternative uses. And those, typically be high value uses. But also importantly, as I mentioned with the ESG targets, we want to invest into those buildings that are either ESG very good at the moment or are capable of being transitioned in the future to meet that net zero target. Thank you. So this final slide just sets out 3 areas where we're focusing our attention in terms of investment into the sub-fund at the moment. And we mentioned throughout this presentation, they're the more resilient sectors where we see the strongest investment returns over our 5-year forecast period. And they're those markets, those sectors where there's good underlying tenant demand, there's resilient tenant demand, and there's a positive supply-demand balance. So, as I said, those are multi-let industrials in core urban locations where there is a limited supply of alternative space, helps to support retention of tenants, but also rental growth. Retail warehousing, again, focusing in Big Six economies, Southeast, big regional centres, where, again, there's a constraint on supply. And also focusing on those assets which are convenience-led, as Andrea said, less impacted by the higher inflationary environment that we're witnessing at the moment. And the same theme applies across the supermarkets. Obviously, they're an essential retailer and have performed well over the last couple of years. So as we said in the right-hand column here, we expect all of those sectors to outperform the market average, and therefore those are the sectors we're focusing on over the next 12 months. That's the end of the presentation. Anybody got any questions?
Thanks very much. Have members got any questions or queries on that? Foolish.
I'll go first. So we've had an amount of money, Sam, committed to this product for a few months now. You talk about the kind of opportunities you're seeing and the challenges that have stopped the fund making any purchases to date.
Yes. So I think the first comment to make is that in the market, as we said at the outset, in the summary of the overall market, we are in a market where there is more limited available investment product to target. So investment volumes are down. What are we seeing? They're down 40% or so.
11% over the quarter, 43% over the 5 years.
Yeah.
Quarterly average. Yeah. Over the 5 years. Yeah.
So we are in an environment where there's more limited stock. But we have been looking at opportunities. That we've got a pipeline list of opportunities. We bid on an opportunity in the last couple of weeks. Unfortunately, we weren't successful on that one. We have a pipeline of more investment opportunities that we're looking at the moment. So it's really been opportunity led so far. But we've taken the approach of, there's a limited amount of opportunities physically on the market that have got a brochure that people are going out and marketing far and wide. So we have approached other landlords directly in order to have a one-on-one conversation to see if there's any opportunities we can unlock through some landlords looking to downweight their real estate exposure. And there are some of those funds that are doing that. The open-ended funds, some of the defined benefit pension funds are reducing their real estate exposure. So we're constantly having conversations with those types of parties.
Thank you. Has anyone else got any other questions? Bill.
Thank you, Chairman. Yeah, thanks for that presentation. I've got a couple of points I wanted to raise. Could you just clarify what you mean by this phrase, the big six regional economic locations? What are you talking about there?
Yeah, so that phrase typically used for it's I guess came from the office market. It's those bigger regional
yeah, well, which ones
markets.
Are they?
So,
could you just spell that out, please?
So it'd be Birmingham, Manchester, Leeds, Bristol, Edinburgh, Glasgow.
Yes. Yeah.
That's great, thank you. So just picking up something that you've said, and sort of, just trying to clarify in my mind. So if what you said is there's less opportunities, and there's a lot of people in a similar position to yourselves with cash in the bank, from people like the pension fund here, looking for those opportunities, isn't it a situation that it's a danger in that asset values have actually been, should we say, inflated because there's more money chasing fewer opportunities? It's a law of supply and demand, and therefore, how does that feed into kind of investment return? Because it's not a stellar investment return, is it? It's pretty low when you compare it to how much you can currently get. I mean, obviously this is long term, but if we just take a snapshot, currently I can get 5-6% just sticking the money in the bank. Why do I want to take it? And I'm just hypothetically just saying why. What's the benefit of what we're doing here? Because I just see in my mind, I'm just thinking, well, we're just chasing around money in southeastern London and in the 6 centres you just talked about. And earlier on, when you weren't here, there was a discussion about investment in local areas. And so I'm just wondering how that, and I know that's not the focus of this discussion, but I'm just curious as to how that helps, anything. Because it just to me seems we're just chasing around after. I know you're not, but I'm just kind of trying to understand how it works and how you make sure we're not overpaying for assets, because you've just said there's less in the market. I assume there's a lot of people looking for those opportunities. So how do we make sure we don't overpay and we don't get stung? Thank you, Chair.
Yeah, Very good points. There are, whilst there is less products in the market, there are also fewer buyers in the market at the moment, and that's partly as a result of the economy we've gone through over the last 12 months or so, the inflationary environment, the interest rate environment, and there's a degree of some investors waiting to see what happens. I think in terms of it pushing up pricing, what we have seen, particularly in Q4 last year, is the market went through a period of repricing. So now we're in an environment where pricing looks far more attractive than it would have done 12 months ago. And I think through this year, in terms of active transactions across those more resilient sectors, industrial and retail warehousing, prices have held relatively steady, give or take. There hasn't been a significant increase in pricing. We are, as a market, forecasting some falls across the overall market. We talked about the office market. And then looking ahead, we expect to see some capital appreciation over the remaining kind of 4 years of our 5-year forecast period, again across those more resilient sectors. And the 6.1% forecast return that we talked about, that is over the 5-year period. It incorporates all of the property sectors, but there's a lot of variance within the individual segments which sit within that. First of all, if you split out 2024, we're broadly saying that's going to deliver a flat 0% return, just slightly positive return this year. But then looking ahead for the periods 2024 to 28, Andrew, remind me what we're seeing.
It's around 7%, just over, for each of those individual years on an all property level. But even then, if you were to split out and look at the various segments, you're going to get quite varied returns. So industrials, retail warehouses, you're at 8 to 9% over that period of time. So even though you might be able to get 5% in the bank, there are still segments of the property market where you might be able to get a little bit of extra if you're willing to take on that amount of risk.
Yeah.
Okay, thank you. Thanks, Nick.
Talking about net zero to 2040 in the property market, there's some pretty meaty costs to actually get there within that, and can be assured that you've either taken that into account and actually got it originally when acquiring, or if you haven't got it at the moment when you're acquiring assets, that you've negotiated a huge discount on the reflection that there's some meaty capital costs coming down the line. Because otherwise, if you don't take that into account, those capital costs, then you might 5 or 6% might be great, but then you'll have a 40% hit.
Yeah, absolutely. It's a key focus for us, both in terms of acquisition, but also in terms of the assets that we hold within the wider business at the moment. And we've got very robust processes to ensure that we are pricing things appropriately, both when we're buying and also when we will review our assets on an annual basis, look at how forecast the returns. So we've got a robust process to make sure that we're building in the appropriate costs to do that. And there's a couple of ways we've done that recently. We've undertaken net zero audits across our portfolio to identify what costs we're going to incur in order to transition that asset to net zero from 2030 to 2040, through the various time periods. And as a result of that, we have a benchmark set of data now that we can use. So, for example, if we have an industrial asset, we know that it's going to cost between 20 and 30 pounds a square foot to transition it to net zero, removal of gas and things like that. So we can apply those kind of metrics when we're buying. And then in addition to that, we have what we call asset improvement plans, which again build effectively a business plan for the asset, incorporating a whole range of different aspects, but also includes ESG and net zero. So we have a clear plan written out for each asset to make sure we're taking the appropriate actions and recognise the appropriate costs.
Thanks very much. Thank you. That was quite a comprehensive answer. Yeah, Mr. Cartwright.
Thank you. Thank you for your presentation. It's my first meeting, so apologies if the question's not quite directed how they should be. But there's taking the market as a whole, there's 100% of the market and there's an area of growth. And you've eloquently pointed out the repurposing of buildings, particularly office space, as not just councils but companies and look to home working and buildings becoming vacant. So we're probably in the area of the most uncertainty that we've ever faced. But that's not because of any other reason than that repurposing. So when you take 100% of a market, that is moving somewhere else. So the home working doesn't help at all. But where they're downsizing to smaller buildings, that does. And it's interesting when you say the key towns that you're focusing on, but as from what I can recall from what you said, the vast majority of those either have air pollution control zones in place or mitigation charges. So your presentation is suggesting, separate to what some of the media are promoting, in that this could have a negative impact on those areas because certain people won't travel into, say, central London or the suburbs now because of ULEZ, for an example. So on one hand, it meets your credentials beautifully, but on the other, it could possibly have an indent into those businesses that you invested in within those areas. So looking at the percentages that you put up on the slide, where it's down this year, up next year, and then falls back slightly to 2027, that to me suggests that you've taken full account of the repurposing of buildings for different uses back into homes maybe, and therefore limiting the space, so then you've got a more realistic marketplace. But on top of that, you've then got the repurposing of major outlets, because I mean there's a cost of living crisis, let's be honest, but if you head down to Foss Park just down the road, it's not evident, it's packed every day. But nevertheless, there is a big change from using the DIY sector for, let's say, somebody like B&Q, not picking out any particular company, but then your tool station and your Screwfix and that operate on a much smaller basis. That has to have an impact in the end on the B&Q, because B&Q had 100% of the market. Now they've got a fractured part of the market. You can go into any large B&Q store and it'd be evident by the number of people. So what I'm failing to understand is I think you've taken a big account of your repurposing of buildings and the change in the retail structure, but not necessarily. And I support you in your climate credentials, but will that? It doesn't seem to come through in your presentation any acknowledgement that actually might affect the yields and the values as potentially customers decline, because where there's a positive, there can be negative. So.
Yeah, thank you. I think the reason we focus on those bigger markets and generally our approach is that we focus on those markets that deliver the most growth, and that could be GDP growth, employment growth, population growth, all linked together. And typically those bigger markets, the big six, are those that sit at the top of the table. But that is something that we do review. It's something that we are alive to, and our focus will change depending on where we see pockets of growth in certain different areas. So it's a guide. We do look at the other areas. There's the Oxford-Cambridge Arc, where there's a lot of demand at the moment, again driven by GDP growth around the universities, which sits outside of that big six market. In terms of repurposing, I think the biggest area that's being affected at the moment in terms of a change in the structure of a market is the office market, which Andrea talked about. And our returns, the bar chart that you referred to, does reflect a fall in value in the office market, reflecting a lower tenant base, lower number of tenants wanting to be in the buildings, and the costs that are coming through in order to either improve your building to meet modern ESG standards. So that is very much baked into those forecast numbers. And I think in terms of wider repurposing changes in business models, which I think you're referring to, the B&Q example, potentially needing a smaller footprint in some cases, tenants do go through various phases of different business models. And I think the key for us is focusing on those assets that are flexible enough to meet both the current tenants' occupational requirements, but also those in the future. So if you do have a larger DIY store, is that capable of being split down into 2 stores where you could have 2 tenants that meets their existing occupational requirements? And that's a key point for us. It's a key element of our investment strategy, is to focus on those assets with that flexibility.
Thank you, Chair. I think I'm right in saying we've got funds allocated, but not yet committed in this sector. And in the short term, we've got falling capital values, I think it's right to say. So it's a question of timing here to make sure that we don't buy something and then in the short term anyway, asset value is full. Just wonder what your thoughts are on that, making sure we get the timing right.
Yeah, thank you. I mean, it's always very difficult to time a market, and I think, you know, why would you invest at the moment? I think it's because you're comfortable that you've got a good quality asset. You're buying into a market where there is ongoing tenant demand. So if there is any distress in the occupational market, you can replace those tenants. It's buying into those sustainable markets. So, you know, we do see an opportunity as well there. You know, we talked about the availability of opportunities. There is also a more limited number of investors competing. So we see that as an opportunity. You know, I think, as we said at the outset, we are positive on the resilient sectors, but cautious on pricing. So, you know, we have to price everything on its own merits, but we're very careful that we're looking at things, and we look at them, as you mentioned, we look at it over the long term, over the 5-year period. You know, we'll price it today, but if it delivers a return appropriate to the risk of that asset, then it should be a buy signal. That is something that we would look at today.
Just come out, just make sure, for the sake of 6 months, they get a better return, because it may drop. Obviously, I don't know, you guys know, it may drop to 1 or 2% in the next year. And that could be, obviously, if you get the timing right, leave it 6 months, you get a greater return in the longer term.
Yeah, I mean, like I say, it's difficult to time it. You know, you might wait 6 months, and there's, you know, a lot more people looking to invest in the market, and the opportunity to buy is no longer there, or it's more challenging. So it's a balance between the two. I completely take your point. But, you know, I think if we're looking to invest over a 5-year period and we're delivering the returns, then you know, it meets the risk-adjusted return we're trying to deliver in the asset. Then it's still a positive signal to buy.
Roy.
Yes, thanks, Chairman. I was going to introduce some topicality. I still am, but we've covered the home working one. I presume you don't have properties built 50, 60 years ago out of strange concrete, so we'll pass by that one. But do you still consider Birmingham a dynamic Big Six target population, given their recent political upheaval?
Yes, we do. It's one of those larger markets. It's one of the markets with, you know, as I mentioned, the growth, GDP growth, employment growth, population growth. Within the urban environment, there's a constraint on land, which helps support pricing, helps support rents, helps support growth. So yes, we do.
Okay, thank you. Thanks very much. Has anyone else got any other comments or queries? I think we've had a very comprehensive presentation and plenty of questions. Thank you, Sam and Andrea, for coming along this morning and presenting to us. So we are asked to note the report and the presentation. Is that agreed? Yep. Thanks very much. So, Mandy, thanks for coming along. Appreciate it.
Thank you very much.
We certainly put you through your paces this morning on every aspect, I think, and a few I hadn't thought of.
Very much.
So we now move on to agenda item 10, which we have the summary valuation of the pension fund investments on pages 159 to 178 of the agenda. Bhulesh, could I ask you to present this report?
Thank you, Chair. It's our standard quarterly report, which covers off the valuation of the pension fund. It also provides an update on the progress with respect to the listed equity changes, which were approved at the April meeting of the subcommittee. Moving on to point 3, you'll recognise the fairly standard table that we have every quarter now. Only one asset class now shows double-digit growth over a 20-year time frame, which is gold. Sterling high yield debt dropping out this quarter was 10.6% over the 20-year period at the last meeting, the 31st of March table, and property dropping below 10% per annum returns over 20 years back in 2022. Not surprising given the kind of repricing we've seen in property over the last year or so. The next standard part of the table is the portfolio standard part of the report is the portfolio changes in the quarter just ended. Not much to say here. A lot of the hard work was done at the back end of 2022, and 2023 has been a lot quieter in terms of commitments called by managers. We do have at the minute though over £500 million in uncalled commitments, and that kind of illustrates the approvals made by the committees over 2021 and 2022. Most of these commitments are to a variety of LGPS central funds, namely private debt, infrastructure, private equity, and UK property, which we just heard from by DTZ. As they do get called, our pool percentage will increase and our alignment to our strategic asset allocation will improve. 6 to 13 is our kind of standard market backdrop. Point 6 summarises the last 18 months. Point 7 talks about how returns have been resilient. The fund's combined holdings returned 4.2% over the last year to the end of June 2023. Although positive, it's kind of dwarfed by the returns we've seen over the last 3 years, which were kind of boosted by the post-pandemic bounce, which averaged 7.7% per annum over the last 3 years. Going to move over to point 11. There is focus on a global recession, kind of either hard or soft landing, with commentators making a case for either, which is backed by whichever evidence that supports that claim. Importantly, though, for a fund like ours that is open to new members and liabilities extending far into the future, taking an always invested position is important. The fund from a listed equity perspective is highly diversified. It's exposed to many geographies and every major sector. It's well known that a major source of investment returns is asset allocation. The rebalancing of the fund to the target strategic asset allocation is therefore of importance, and where appropriate and in line with the rebalancing policy efforts are made to rebalance. The legal and general investments, these are the passives that we have with them, rebalance automatically via instructions in place with the investment manager. The investments with LGPS Central, which we will come on to look at later, require manual dealing instructions to be placed to rebalance the strategic asset allocation. The next standard piece on this report is our cash holdings. We don't have a strategic asset allocation for cash. It's kind of 0%. But it's hard to maintain a 0% in reality. So we've always held cash, and at the quarter end, the fund held 50 million, and there's an additional 55 million held as collateral with Aegon to support the currency hedge. That's about 1.8% of total fund assets. And given the large amounts of uncalled commitments, as stated earlier, holding some cash is preferable over having to divest at short notice, especially given the rates available on cash deposits have increased significantly over 2023, and at present, cash held overnight earns in excess of 5%. We've got a short section on the overall investment performance, covers the kind of quarter, 1 year, 3 year, 5 year. We've got a more comprehensive report at Appendix A, but you'll notice the table at point 23 is the kind of standard one that we see each quarter. 1 year, 3 year and 5 year. So at 1 year, the fund's the 4.2% we mentioned earlier, which is 0.5% behind its benchmark, and we'll come on to why. The 3 year and the 5 year numbers are also listed there at 7.7% over 3 years per annum, and 5.9% over 5 years per annum. And the 1 year underperformance versus the benchmark is 0.5%. It's mainly driven by the growth asset group. So that's equity in general, and in particular, the active elements of this asset group. So that's the underperformance from two main areas. The targeted return funds. So they're the 3 funds that we hold, which have a benchmark of cash +4. They underperformed by 4.2% over the year. They managed +3.5, but given it's a cash +4 benchmark, it's a a higher hurdle to reach. There's a table at point 25 which talks through the rationale and the reasons that have happened. The second active investment in that growth bucket is the LGPS Central Emerging Market Equity Fund, minus 3.2% to the benchmark. I won't read through those. We'll move to the second part of this paper, which is the overview of the fund's listed equity investments at point 28. There's a table there at point 28 which lists the fund's listed equity holdings. Now, it's kind of split into 2 sections. You'll notice the first 6 or 7 rows are LGIM funds. So we've got a UK equity fund. We've got 7 single stock funds there, which are Unilever, Glaxo, HSBC, Astra, BAT, Shell and BP. A number of regional funds, so the North American fund, a European fund, a Japanese fund, stretching all the way down to a world emerging markets fund. And then right at the bottom of that table, you've got the 3 funds with Central. So there's a global active equity fund, there's a emerging markets active equity fund, and a climate multi-factor fund. Although it looks complex, the fund's total listed equity holdings are quite straightforward. The fund uses just 2 managers, Central and Legal and General. All the actively managed products are with Central, and the largest mandate is with Central, which is the climate multi-factor fund. We've talked about this at length during today and previous meetings. The LGIM holdings are very low cost passives, which were collectively procured and represent really good value for money. And as a reminder, it's worth noting that the total lineup for listed equity will be revised in line with the recommendations approved at the April subcommittee meeting. These changes can be summarised as simplifying the passive holdings at LGIM into just 3 holdings: a UK passive, a global passive, and a global low carbon transition fund. In addition, a decision was taken to divest from the Central Emerging Market Equity Fund and to equalise the weight to the Climate Multi-Factor Fund and the Global Equity Fund. The net effect will mean that the fund will be able to align to its strategic asset allocation for listed equity at 37.5%. Are there any questions at that point before we move on to the next section?
Has anyone got any questions so far? No? Oh, Clive.
Just to say, well done on getting 5% on the overnight rate. That sounds impressive.
Yeah.
Ready for that? That's just markets as it is.
All right. Good stuff. Can I?
Yeah.
I think you should take credit, Bullish, even though it's nothing to do with you, but
Bill. Yeah, thanks, Chairman. Just a couple of queries and clarifications if I can. The outstanding commitments, am I right in assuming that's the uncalled commitments? That's money that's been allocated, but as we heard earlier, that's sat on it, waiting for the right opportunity.
Correct. They don't sit on it.
Not literally.
They don't actually have the money. We have the money until they call it. So
yeah.
we get the benefit.
Excuse me, terminology, but
so we get the 5%.
Yeah. So basically, the money's held by county technically, and it's in our accounts or treasury account somewhere, earning some interest, or the pension fund interest, and until it's called down by the investor. But it's in effect it's a allocated pot of money. Right. Okay. That's fine. I understand that. So just thinking about that, that's currently around about, if we've got 5.5 billion under investment, that's just a shade under 10% of the funds that we've actually got, approximately, depending on what the valuation is. And I'm just wondering, is that a relatively high amount historically, or is that
So
half of the course?
Yeah, so there's two elements here. So we have an element sitting in cash, which is
That's the 50 something
50
million.
million,
Yeah, I got
which is,
it. Yeah.
and the 55 that's with Aegon that supports the hedge. That's pure cash. The other 500 or so billion isn't sitting in cash. It's sitting in other asset classes which are invested at the minute. So the hard part is just knowing when they're going to call it and having just enough cash. So we don't want to hold too much cash.
Right. Okay.
We don't want to hold too little either.
Okay. So it's currently invested, but we're going to move it, shuffle it from one thing to another. Essentially, that's what we're talking about. Okay. I just wanted to clarify that because, you know, I'm not an investment expert. Okay. And just on this rebalance, paragraph 12, you talk about the LGPS central acquiring dealing. Am I right? Are those dealing instructions in place then, since you've written the report? Are they going to happen? Is that what you said?
We have a rebalancing policy. So if, for example, global equity, which will have a target weight of 12%, becomes 11 or 13, we'll rebalance accordingly. But it's a manual instruction.
Okay, so that's not happened. So that's going to happen over the next sort of quarter or a year, or
it happens when we get a quarterly valuation for the whole fund. So we get a valuation for the whole fund. You'll have one as part of the package in Appendix A, and we have targets against each of those holdings.
Okay, that's great. And finally, Chair, if I can, paragraph 21, it says that last year, portfolio evaluation, I presume that's the company that evaluates the portfolio, said they were closing their business and we were looking into options and we'll report back on any updates. So I'm just wondering, given that was last year and the business, I assume, is closed or closing by the end of this year, when are we going to get an update about that?
That's a typo. That should say 2023. But yes, plans are in place to transition that service to a new provider.
Okay, thank you, Chair. Thanks.
Okay, thank you. So this is a pretty comprehensive report and Buldesh has gone through it in great detail. Is there anybody else who has any questions or comments? No? Right, so the committee is asked to note the valuation of the fund. Is everybody happy to do that? Okay, so we're on to agenda item 11. It is the report on risk management and internal controls, pages 179 to 188. Buldesh, over to you to present.
Thank you, Chair. Again, standard report each quarter, 18 risks split across 6 different risk areas. Those areas are investment, liability, employer, governance, operational and regulatory. Point 8, following the June 2023 local pension committee meeting, there have been some additions to risk number 3. The local pension board considered the revised register in July, from which members requested an extra column to indicate whether the residual risk has changed to easily identify changes. That's been added as well. There's been no change to the risk scores quarter to quarter. And to meet fund governance best practice, the risk register has been shared with internal audit, who has considered the register and is satisfied with the current position. The register is attached at Appendix A, the scoring matrix and the criteria at Appendix B.
Thank you. Does anyone have any comments or questions on the risk register? It's clearly stated. Mr. Cartwright.
Thank you, Chairman. Just something I'd like to say first before asking a question, because it may be directed at this agenda item 11 or 13. The first thing I'd like to say, Chair, and please minute, as a new member of this committee, I'd like to thank Angie particularly for the administration of bringing me on board, and to Buldesh and Kat for the training advice and support they've given me in the pre-meeting stuff. I know it's not this agenda item, but it's the first time appropriate that I could bring that up. So if you'd minute that, so I'm extremely grateful to the 2 officers who gave me the training and support, and will be ongoing with that, and Angie for her administration skills in bringing me on board. That'd be appreciated. I wanted to raise the Hinckley and Bosworth Borough Council motion to council. A question of clarity on that. I don't know whether you want to, that's appropriate to bring it up now as a new member, or to wait for the responsible investing update. I'll be directed by you, sir.
I would suggest, I think that's already been dealt with, if I'm right. There was a letter that went out to all members issuing our response to that. So over to you, Kat.
Yeah, I suppose it was, but just before you joined, I know we had, was it? I might just be confusing which ones, but we have previously issued the response that we've provided to a council resulting from the notice of motion regarding divestment, but we can recirculate that to you because so I'll have to check my record.
You're talking about notice, divestment notice.
Yeah, well, I'm asking. I'd like clarification. The letter that came back out to the Borough Council as a result of the motion, was it directed by the chairman, because it's not clear, or was it directed as a result of a discussion on the 16th of June that I wasn't at, or a member of the committee at? So was there a discussion on the 16th of June that resulted in the letter, or was it just a letter that came as a result of the chairman? And the second part of that would be, given that the districts that are linked to this are an important part of it collectively, as we all are, and the potential for other motions that have either been tabled or maybe tabled in the future, could they speak just an agenda item? Because I'd like to understand some things around it, but don't want to confuse it with other agenda items on the agenda.
Yeah.
That's why I wasn't sure whether it was this item or item 13, or whether it just needs tabling for the next meeting.
No. To be honest, the responsibility for the LGPS pension fund rests solely with this here. Now, there's nothing at all to stop anybody passing a motion at their district councils. We have a net zero climate policy. It has been through the committee. It has been agreed by the committee. It's been agreed after consultation with all the members of the pension fund. I think we went out twice to the members of the pension fund. So there is a very direct and clear policy that we have, and I think the responsible investment topic coming up, it wouldn't be appropriate to put it on as an agenda item, because it isn't. In honesty, the maintenance of the LGPS and operation of the scheme is totally the responsibility of Leicestershire County Council and also the Leicestershire Pension Board. So no matter what the councils or anyone else says, we have a clear strategy, we have a clear duty, and we will execute that. So the letter really tried to address the concerns of the district council based on the policy that was agreed after consultation with the members of the committee and all the members of the pension fund. And I think the efforts that we've gone to, I think the report on responsible investment shows there is a very clear direction of where we are going and what we want to achieve. Sort of summarising, complete divestment immediately to somebody who doesn't have the same influence or interest in making sure that we do evolve to a net zero carbon is probably not a good strategy. Now, people may disagree with that, but we have the ability to lobby, which you will see the responsible investment report does show just how much work has been done, and it's not insubstantial. But that's all I'd say. And we will continue to answer any queries or motions passed by district councils, but to be honest, it's not within their gift. Have we got any other questions or queries? No. Okay, so the committee has been asked to note the valuation of the fund. Is that agreed?
It's the risk report, Chair.
Risk register.
Oh, risk, sorry, the risk register, sorry. So the committee's asked to approve the risk register. Is everybody happy with that? Yep, yeah. So we're now on to the next item on the report, which is the community admission bodies of the Voluntary Action Leicester and Bradgate Trust, pages 189 to 200. Declan, over to you to present this report.
Thank you, Chair. Just to flag up initially, this is a slightly odd report in a few ways. One is it's not a topic that comes here very often, once every sort of several years. And the other one is, obviously, I represent both sort of or I'm employed by the County Council and sort of work on behalf of the fund as well. And there's sort of both parties are involved in this report. So there's a potential conflict, but the interests of the fund and the County Council are aligned in this regard. So it's kind of a manageable conflict. So what this report kind of covers really is historically voluntary sort of sector bodies that sort of provide a public service used to sort of join the sort of the LGPS, and it tends to be sort of decades ago when the sort of the belief was sort of the defined benefit sort of pension scheme offered was affordable. So sort of obviously kind of more recent kind of experience has sort of proven that these are pretty expensive. So it doesn't tend to happen very often now, but back then, like I say, you are talking decades back in sort of the 70s. The historic arrangements didn't put in place a guarantor, which if it was happening today is something the fund would absolutely insist on before they were sort of allowed to join the scheme. And the reason for that is because if one of these bodies did get into financial difficulties, the liabilities spread across everybody else. We're sort of a last person standing scheme, as it were. So, and that's obviously not a situation the fund really wants to get in. You're in a real sort of a world of sort of trouble trying to explain that to 200 different employers while they're having to sort of put their hand in their pocket, as it were. So what the fund has been working on over the last few years is to put arrangements in place as if would have tried to do it back at the sort of the admission of the scheme. And unfortunately, the voluntary action Leicester and Leicestershire and Bradgate Park are the final two that we've got to do this with. We've just been working through them slowly. So the proposal is that the county council would guarantee voluntary action in Leicestershire, and the city and the county together would guarantee Bradgate Park, like I say, just to reflect, this is how the guarantees would work when the sort of the arrangements were first put in place, if they had been put in place at that time. So for Val and Bradgate, the benefit is that they get a reduction of the risk, and that can be sort of significant on their sort of in relation to the size of their balance sheets. And for the county and the city councils, it's seen that they're in a much better place to take on this risk, as we can take sort of a view over multiple decades, which you obviously have to do when you're dealing with the pension funds. And the size of these liabilities are pretty small compared to the existing liabilities that the county and the city already have. So the recommendation of the report is that is to approve the transfer, and hopefully that's a sort of a fairly straightforward thing for the fund, because actually it is just a sort of a net reduction in risk for the fund, and the other mechanics are between the voluntary sort of bodies and the sort of the two local authorities. And these sort of these arrangements have to go through the decision-making process with the full sort of the four bodies. And like I say, so hopefully it is a sort of fairly straightforward thing, sort of the fund taking on those risks. So happy to take any comments or questions.
Okay, has anybody got any comments or questions? Nick?
Putting the hat of the fund to have the guarantor actually, signed up in blood or whatever, it is obviously, reassuring for the fund's point of view. So I think from that point of view, which is the main point of this committee, is that's a positive step. But looking at the numbers, Bradgate Park's a bit small and average, but if everything goes as expected, which it probably won't, but it might, is the county going to make a nice little profit out of Val?
It's, in theory, yes. Like you say, it's kind of on the weight of probabilities. You would expect, if you look back on this in, 10, 20 years' time, it should have done. And it's why the kind of, in some ways, we leave it to Val to request, as opposed to us sticking our nose in and saying we think this is a good idea. So it's kind of, so Val are obviously aware of those figures. If Val don't want it to go ahead, they don't have to. But on that weight and probability, yeah, and this is what I'll say to Cabinet next week, is that, in 20 years' time, we should be able to look back on this based on the sort of the investment return assumptions that we've got, and the county should end up ahead. Hope, the quid pro quo is that the Val get rid of the liability off the balance sheet that could cause them, they're more sensitive to the downside risks than we are. But yeah, that should be where it ends up.
Very nice way of summarising it, Nick. I haven't sort of been through that. Roy?
Yes, thanks, Chairman. I will abstain on this one. I don't think I have an interest to declare per se, but both Val and the Charnwood Forest, Bradgate Park, are on the same committees I'm on in terms of Charnwood Forest Steering Group and the Charnwood Forest Boards as well. So I'll drop out of this conversation.
I fully understand. Thank you, Roy. if we just note that. So if there are no other comments or queries.
Chair, the same applies to the Charnwood Forest, so I'll drop out of the debate on that too.
Thanks, Mr. Cartwright. Any other comments or questions? No. So the committee has been asked to approve the transfer of the voluntary action Leicestershire pension fund assets and liabilities to the County Council, the transfer of the Bradgate Trust pension fund assets and liabilities equally to the County Council and Leicestershire City Council. Now, I know that both Roy and Mr. Cartwright are going to abstain on this one, but apart from that, is everyone else agreed? Yeah. Thanks very much. Thank you. So we're now over to the agenda item 13, which is a fairly comprehensive report on we have an update on the responsible investment strategy that we've got as presented in the report at pages 201 to 214. Kat, over to you. I know a tremendous amount of work's gone into this, and I think the report itself shows just how much work's gone into it. So over to you for presentation, please.
Thanks, Chair. I won't keep members too long because we have the RI&E responsible investment and engagement training with Central to follow. But I suppose just to pick up some highlights. So Appendix A sets out the progress of our responsible investment plan, which committee agreed in January. We also have Appendix B, which highlights the votes within the quarter. Members will note that it was a significant period of having the main European and North American annual general meeting season. So we voted at over 3,000 meetings, which amounted to over 50,000 resolutions. At 2,700 meetings, the fund opposed one or more resolutions, and the majority of those related to board structure. There was mixed commentary as a result of the AGM season, so we saw increasing investor dissension as shareholders lost patience with some companies' response to the climate crisis in Europe, while in North America, support for the climate-related and social shareholder proposals fell. The report also highlights two votes which received over 20% dissension, with JP Morgan and Glencore that the fund supported, and that 20% level seen as quite a significant level of dissension. So those companies will need to go back, consult with their shareholders, and then publicly respond to what they're going to do, or how they're going to respond to those that dissension. Just a separate note to highlight, government have proposed an economic activity of public bodies bill, and that was introduced to Parliament in June. That aims to prevent public bodies from being influenced by political or moral disapproval of foreign states when taking certain economic decisions. It's important to note that the fund already has built that into its investment strategy statement, and that's a well-established practice in the LGPS. It's just worth highlighting that the Local Government Association and Scheme Advisory Board have raised some concerns over a potentially overreaching role of the pensions regulator in enforcing it, and then also the wide scope of judicial review. But it's at a very early stage at this point, so we'll obviously update you if it comes to fruition. And that's all I'd say. Report, Chair.
Okay, thanks very much. It shows the work that's been going on. We're going to be regularly updated on this, and as it evolves, the metrics will become more and more significant, and so there is considerable interest in this by committee members, and rightly so. So does anybody have any questions or queries on the responsible investment? Well, Roy.
Yeah, I'd just like to point out that if we were not to have holdings in some of the companies we don't entirely approve of, somebody else would have those holdings. And whilst we're there, we have the chance to influence them, which I think is something we must protect. I think we can get overboard on what we would like to see, but our primary interest is fiduciary. I've got a bad throat and it's a hard word. Fiduciary duty to our pensioners, and we must do the best by them.
Yes, we have, but we have significantly more influence by being able to lobby them and vote. And whereas if we divest, somebody will not be even remotely interested in climate change, whereas we are very interested. So good point, Roy. Thank you. So has anybody else got any comments or questions? No? No? Okay, so the committee is a committee. In honesty, this is to bring to the attention of so the committee has been asked to note the agreed action agreed by the investment subcommittee. Is that agreed? Yeah, all agreed. Thank you. So the date of the next meeting is scheduled for 1st of December 23 at 9:30, which I have noted. So yeah, British summer time. Yeah. So right, it's the 1st of December. 1st of December. So item 16, any other items which the chairman has decided to take as urgent? As previously stated, there are no other items. We now come to the exclusion of the press and public. I move that the public be excluded during the consideration of the remaining items in accordance with section 108(4) of the Local Government Act 1972, exempt information. Is that agreed? Yeah, agreed. Right, that brings to an end the public part of the meeting, and the live stream will now end.